Okay, what is financial management? Now, when you say financial management, the first thing which comes to our mind is it's all about managing financial resources. So when it comes to managing financial resources, it can be at different levels. It can be at a personal level where we manage individual financing, or it can be at a business level where we manage the funds of an organization. And moreover, it can be managing a country's finance at a national level. So therefore, we see the financial management in a simple context have three main elements. That is at a personal level, and then at a corporate level, and then at a country or national level, we call public finance. So here we are mainly concentrate on this aspect, how a firm should manage their financial resources for a particular period from their available financial resources. Right now, if you take the corporate financial management, it's simply we are giving the specification for an organization, specific for an organization. So that's where we start our process. We said corporate finance is all about maximizing the shareholders' wealth. That is our core objective of corporate finance. So that is our core objective. Corporate financial management refers to maximizing the shareholders' wealth of the organization. Now, when you say wealth, we said it can be in terms of profits or surpluses, or also it can be in terms of capital gains. So, however, a firm to maximize its wealth, you need to look for not just to increase your profit, but in order to maximize the wealth, you need to see the surpluses and also to get capital gains and increase the value of the firm. So in order to achieve this key objective, we need to fulfill another three key decisions. So if I refresh what are these key decisions, first one, where to invest, we call investment decision. Investment decision. And then once you decide where to invest, you need to decide how are you going to finance them. So you call financing decisions. Once you decide how to finance, then you continue your business, continue your project, and you generate surpluses. And that surpluses will get you to earn more profits. And then you have a decision to make, how are you going to distribute that? So that comes to the distribution decision. Some books, they also talks about working capital management decisions, which I will fulfill under financing decision, because financing also you have short term and long term. So as a nutshell, we see the corporate financial management is trying to address three key decisions, that is investment decision, finance decisions, and distribution decisions. So let me start with investment decisions. In a simple context, where we are trying to invest. So when it comes to investments, we learn there are so many investment opportunities in a country. Investments options are there. When it comes to investment decisions, there are so many investment options are there. It can be putting all your cash or surpluses into a stock exchange. It can be investing in real estate. It can be purchasing fixed assets. Even it can be investing for new businesses. It can be even for investing in gold, silver, and precious metals. Like that, there were so many investment options. Also, when we list down these investment options, we realize some are very risky. When you say risky, because the price fluctuations are so high and you will not always have a stable return. So you see a risky investments. And on the same time, we see some investments which are very less risky because we have a guaranteed return. So the less risk investments we talk about, the best option would be investing in treasury bills in the short run, in the long run, treasury bonds. So that will give an assurance. Those who are investing in treasury bills and treasury bonds, the government will give a guaranteed return at the end of the period. On the same time, if you talk about investing in the savings accounts, fixed deposits, it has better security than investing in high risk investments like stock exchange. So therefore, we understand there is a relationship between risk and return. Higher the risk, higher the return, and lower the risk, lower the return. So we see a positive correlation between risk and return. So coming back to these investment decisions, we said that these investment decisions mainly a firm takes for a long term. And these are all for a long term, and you invest a lot of money. So it's a huge investment. The period is long term because its future is unpredictable and unrealistic. You have to look all the options that to measure that your project is feasible or viable. So therefore, we use certain tools to measure and verify whether the project is feasible or not. So in order to understand these investment tools or the measurements, we call measurements where we do an investment appraisal. So one of the main things that we discussed was the payback. And then we talk about ARR. We talk about NPV. We talk about IRR and discounted payback. So what is payback? Payback means it is the period where your initial investment is recovered. It is the time which will take to recover your initial investment, payback. And shorter the payback, we give the preference because such projects are more liquid and the company will be able to return their investment more safer and quickly. So we give the preference for such liquid projects. So payback is easily calculated and by using cash flows of the project. So we know how to calculate the payback. And then we discuss what are the main advantages of payback. So the main advantages of payback, we said it's easy to understand. It's also easy to calculate. And even a person doesn't know about financial knowledge, it's very easy to understand what is this technique all about. And it also gives the preference for more liquid projects. However, it has its own problems. One of the main problems we discussed, it ignores the time value of money. And when the project has long-term cash flows, we ignore all the cash flows after the payback period. So that is another major weakness in payback because we don't account for cash flows after the payback period. And also, there are so many projects where you take a long term to recover. For example, like investing in a highway, investing in a hospital or a hotel, or even like an apartment, a building, which takes a long time to construct and recover the initial investment. So it is said that for such projects, payback is not a good tool to calculate and understand as an appraisal tool, because the payback naturally is a long, it will take a long time to recover your initial investment. But that does not mean your project is not viable or not profitable, but that's the nature of the project. And when the payback is same, you can't take a decision. So you need to have a clear difference between the first or the second or the third project to select or rank. So with that weaknesses, we move on to the next topic we call accounting rate of return. Some says average rate of return. In accounting rate of return, we calculate the profitability of the project. That is the only tool which account for the accounting profits. Where all the other tools we use the in all the other tools we used cash flows, but in ARR we use the accounting profit. So we calculate the expected accounting profits that you are going to generate for the life of your project, and then you divide by the initial investment or average investment. Based on the formula, you can calculate the profitability of the project. So here, higher the ARR would be, higher the preferability of the project, right? So the advantage here is we account for all the accounting profits of the project, unlike the payback period. However, the common weakness that we see is it also ignores the time value of money. And also, because it's an accounting profit, sometimes it can be manipulated. So therefore, we have a reliability issue in such tool compared to the other tools where they use cash flows. So therefore, we move from ARR and payback to NPV, because in both payback and ARR, we ignore the time value of money. We believe time has a value and it can be measured. So if we ignore the time value of money, that we are doing a major, that's going to be a major weakness in your project appraisal. So we account for the time value of money simply applying an equation. So the equation refers as future value equals present value 1 plus R, which is the rate or cost of capital or rate of return, into the power n, which is number of times. So applying this formula, we can convert the cash flows either to the present value or to the future value, and then use the cash flows to calculate the net present value of the project. In this tool, we convert all the future cash flows into today's terms and take all the cash flows to a one-time line. And then we arrive the net present value, and the rule of thumb is if the NPV is positive, we will accept the project because it will increase the shareholders' wealth. If the NPV is negative, we reject the project because that will create a loss or negative value in the shareholders' wealth. So with that assumption, we can calculate any NPV of a project where we need to propose the future cash inflows and outflows and arrive the net cash flows. This is where we are doing the adjustments like inflation, adjustments like taxation and taxation benefits, and all the adjustments will be maintained and arrive the final net present value of the project. Once we learn the NPV, one of the main advantage, we account for the time value of money. As a disadvantage, we can say it will take more time to calculate and it will become more complicated. So moving on from NPV, we go to IRR. IRR refers as the rate where your NPV is 0. In other words, if you use IRR rate to appraise your project, your NPV, the net present value, is going to be 0. We can calculate the IRR for any project simply using two methods. First one we call the trial and error method, where we use a hypothetical rate and calculate the NPV of the project. And we will calculate until we get the NPV 0. Because it's more time consuming, we have the IRR formula where we apply to calculate the project IRR for any organization. This is where we apply the internal rate of return as we have the percentage A, that is the rate. Now you need two basically calculations, two NPVs to apply to this formula, and always the lower the rate that where you choose as the cost of capital is going to be the percentage A, and then you calculate the NPV of A, which is going to be, when you use the lower rate, you can calculate the NPV of the project, and that you divide by again NPV A minus NPV B, which is the other rate. So once you do this calculation, you multiply it by percentage B minus percentage A. That will give you the IRR of the project. So once you calculate that, you can arrive the rate where your NPV is 0. And we discussed the IRR is a good tool where we can use to calculate the best rate where you can finance your project. You can use the IRR because IRR is the rate where your NPV is 0. For example, if you get an IRR rate of 12%, that means if you borrow a loan at 12% of interest, your NPV is going to be 0. So therefore, you must take a loan below the IRR so that you will get a positive NPV. If you get a rate higher the IRR, that's creating an NPV to be negative, which will be rejecting your project. So it's a very simple thing that we remember. Higher when you have a cost of when your interest rate is higher, means you are going to make losses because you have more interest to pay and your NPV is going to be negative. But when your cost of capital is lower, means you are going to get profits because you are paying less to the bank. So with that assumption, we calculate the IRR. So it is a very important tool in financing decision as well in the project appraisals. So this will help before even starting the project to decide whether to accept or reject the project. So one of the main advantages, it helps you to take decisions in financing and deciding whether to accept or reject. However, the drawbacks of IRR is, especially when the cash flows are non-conventional, where you find negatives and positives throughout the cash flows coming into your project, you may tend to have multiple IRRs. Because of multiple IRRs, the validity and the reliability of IRR is going to be questionable. And there are some more weaknesses. This is the main weakness I want to highlight. So with that IRR, let's move on to the discounted payback. Now, I said the payback has a weakness where we ignore the time value of money. So in discounted payback, what we do is we convert all the cash flows of the project by accommodating the time value of money, and then we convert all the future cash flows by accounting for the time value of money and use the discounted cash flows and apply the payback period. So therefore, it will recover the time value of money, but the rest of the weaknesses will remain same. So with that, I would like to conclude the main features or main tools that we use to appraise the investment or projects. Right, let's move on to financing decisions. Now, we said that once you decide where to invest, the next important decision is to see how are you going to finance. Like I said, mainly a firm can be funded by two sources. One we call the internal source, which we call the equity. The external source, the other source we call the debt. So, in a very simple context, a firm has the equity and the debt version. Now, when you say equity and debt, it has its subsections of it, sub-sources, but here we are trying to see the main sources of the finances. Now, then we need to understand what are the main factors affecting to the financing decisions of a firm, or what are the main factors that we need to consider before taking the financing decision of the firm. The first one is we need to understand the cost of that. What is the cost of financing your project? And also we need to understand what is the, when you say this cost, whether it's high or low. And also we need to understand what are the terms and conditions of this financing, and what are the terms and conditions, or what are the period that we need to settle them, and what kind of collateral or security that we need in order to finance. So like that, we have so many factors that we need to consider before we take the decision, the financing option. And the other important thing is, now when you say these, the factors, then we need to understand the cost of that, which is the key factor of the financing. So when it comes to equity, we calculate cost of equity, KE. When it comes to debt, we calculate cost of debt. And we also found that there is another instrument where we call hybrid instrument, which has the features of equity and also the features of debt, which we call the preference shares, and we calculate them as KP. So let's try to understand how to calculate KE of a firm. Mainly, KE can be calculated by two ways. Two models we use to calculate the cost of equity of the firm. One we call the capital asset pricing model of the firm, capital asset pricing model. The other one we call the dividend growth model, capital asset pricing model and the dividend growth model. Now, what is capital asset pricing model? Where we calculate the KE of the firm by understanding the risk-free rate, and then we take the market return, that is market rate minus the risk-free rate into the beta factor. So this we call the risk premium. So we can calculate the cost of equity of the firm by applying the risk-free rate, market rate, and the beta factor. So risk-free rate, just to refresh, the rate where your risk is zero. We normally take the treasury bill rate of the country. Market rate is simply the average rate or return of the securities of the country. And we can use this, we can get this calculation by getting the all share price index of Colombo Stock Exchange, which will represent all the sectors of the country. And then we can find the beta value, where it measures the risk factor of the particular security. So beta is calculated for every firm in the Colombo Stock Exchange, and it will show the responsiveness or the sensitivity of the share. If the beta value is high, which we call more than 1, we believe that that particular share is increasing at a higher rate, more responsive to the share market. In other words, if the share market change by 10%, such beta value firms will increase more than 10%, which gives you a value more than 1. If the beta is less, we show the responsive is less and more stable shares. So where even the market changes by 10%, this company will be changing less than 10% because the responsiveness is low. So therefore, so we can understand the type of shares, the risk factor, by calculating the beta value of the investment. Then we use the dividend growth model to measure the cost of equity, where we calculate the KE by getting D0 P1, which is we call the P0 the price, and D0 1 plus G as growth rate. So we can further say D0 1 plus G means dividend in 1 year's time, which we can also say as D1. So D1 is the dividend in 1 year's time. P0 means the current market price. And if you add the growth rate, you calculate the cost of equity of the project. So this is the way you arrive the cost of equity by using the dividend growth model. So once you calculate the cost of equity, then we can move to cost of debt. Now, when you say cost of debt, simply when you take a loan, cost of debt means the interest rate of the loan. However, when you have taxes, we have we learn this tax has a as a tax is a we call this it's a deductible expense, or we can set off the interest from the taxation. We calculate the post-tax interest rate. So how we can calculate the post-tax interest rate is the KD, cost of debt, you can calculate. The post-tax interest rate is 1, which is the 1 minus T, equal gross interest into 1 minus T. The T refers to the corporate tax of the firm, divided by value of the debt. So this will calculate the cost of debt of the firm. And then we can arrive the cost of preference shares. Cost of preference shares refers to KP. Since the preference shares have fixed dividends, we can calculate the fixed dividends as a percentage of the value of the preference shares. You can say cost of preference shares as KP. Now we calculate cost of equity, cost of debt, and cost of preference shares. Once we calculate cost of equity, cost of debt, and cost of preference shares, we can arrive the overall cost of capital of the firm. This is where we are using the weighted average cost of capital of the firm. So here what we are trying to do is we are giving the weightage for each and every value, whether it's equity, whether it's debt, or whether it's preference shares, and try to calculate the overall cost of capital of the project. So let's try to understand this by using the simple formula. We can calculate the weighted average cost of capital. For that, you need to know the cost of equity, and you multiply it by the total value of the firm, which is we have this value of equity, value of debt, and value of preference shares as a percentage of value of equity. So here we calculate that. Like that, we calculate for cost of debt also, multiply by value of debt as a percentage of value of equity, value of debt, and value of preference shares. And further we add the cost of preference shares by value of preference shares divided by when we take this cost of debt, we can calculate, let me write it here, and we further add cost of preference shares KP into value of preference shares, value of equity, value of debt, and value of preference shares. So when you add all that, you can arrive the weighted average cost of capital of the firm, and that represent the firm's overall cost of capital, and that is the rate we use to appraise the projects. That is the rate we use to appraise the project. That's very important that you need to calculate. Right. So then we need to understand what are the when you say these financing sources, the short-term financing sources and long-term financing sources. So we have mainly two types. We call the short-term and the long-term. What are the short-term financing sources? Mainly we talk about overdraft facilities, where the firm has the ability to pay or settle payments more than the balance that they have in their current account balance. And then we have short-term loans, and we can make credit purchases. And then we can take, even you can use the corporate credit cards, and plus we can say bill of exchange or commercial papers like that. So these are some of the short-term methods that the firm will use to finance your project. When it comes to long-term methods, there are so many methods that are available for a firm, starting from even you can look for long-term loans, issuing shares, and also you can look for leasing facilities, especially finance leases, where we talk the operational leases on the short term and finance leases in the long run. And also we can think of debentures. Debentures also used for long-term financing. It's where the companies issue to the public and collect finances through public. And also we see many other tools like mortgages, convertible bonds, and so many instruments available in the market for a firm to look for long-term financing sources. When you look at this option as a country, as a national level or a public level, you look for treasury bills in the short run and the long run treasury bonds. And when it comes to personal level, you have short term like jewelries, pawning your jewelries, your cash advances from families and friends and relations, and like that you have personal version of financing your day-to-day requirements. So these are some of the tools that we use to finance your projects. And then we need to understand the nature of the loans and the equity. Now we learn that the debt is also important when it comes to financing a project. On the same time, we have equity as well. So if you look at the main features of these two, we understand equity is the true owner's money. It's your own savings. So therefore, there's a less risk compared to debt. Why they say less risk? If the firm is not performing, the firm is not necessary or compulsory to obliged to make payments to the equity holders. However, debt is an external funding. When the company is not in a position to or performing to pay the interest of the loans, it will be very dangerous, where the financial risk is high, where these debt holders can go to courts and ask to close down the business because they are not loyal to the firm. So like that, we have its own features of debt and equity. So therefore, we need to understand what is the best option in terms of businesses. keep that in mind. Debt is also important, and it's because it will give you tax benefits, and it will reduce the dilution of your ownership, because if you take a debt, you are not liable for any long-term commitment or partnering with your business. But when you issue shares, they are going to be partnered with your organization, and that's going to be a challenge in the future because your ownership will be diluted. So it has its own pros and cons, but I would always recommend look at the cash flows of your project. If you see positive cash flows are guaranteed in your project, in such situations, debt would be preferred than the equity. The simple reason behind this is a debt will be able to, because it's if you have guaranteed returns, it will be more secure because you don't have any dilution of the ownership. However, if you have not guaranteed returns and your returns are unstable, it's good to go for equity rather than debt, because you are looking for more opportunities, or you don't have financial commitments in the short run. So therefore, you have a debate whether to debt or equity, and depending on the situation, business context, you need to choose what is best. So therefore, with that, I would like to conclude the investment, the financing decisions. So let me quickly go to the distribution or dividend decisions. Now, when it comes to dividend decisions, we say that you have now select your investment. Now you have financing. Now you are going to getting your surplus. So once you get your surplus, then you need to have a quick decision. How are we going to distribute them? The main two options is either to distribute 100% to your shareholders, either to invest. So either to give as dividends to your shareholders, or either you distribute or you reinvest. You call reinvestment. So reinvesting is something that you need to take seriously if based on your available projects. So distribution, or we call this distributing is, or giving dividend, is depending on what is the positive NPV projects availability. If you have positive NPV projects, they say you need to do the reinvesting option. If you don't have positive NPV projects, you can go for paying dividends. So if you have enough and more NPV projects from your total funding, just invest all for NPV projects, and if you have anything left, you need to give as dividends. That is from a financial management point of view. However, there are many factors that we need to consider before we take a final decision of a dividend policy. So some of the factors we discussed which will affect your organization. The first thing I would highlight, the nature of your shareholding. So the nature refers to what type of shareholders that you have, whether they are foreign or local, whether they are institutional investors or individual investors, whether they are looking at their age, whether they are young investors or old investors, because that has an impact on your dividend policy. If it is local, most dividend, if the shareholdings are more on foreign, then you tend to pay a very high dividend, but if it is localized, they tend to pay low dividend. If you have institutional investors looking for more long-term capital investments, so they pay less dividend compared to individuals. If there are more individuals, they tend to pay high dividend to the individuals. On the same time, if you have young people, they tend to not to pay dividends, but when you have a lot of old people in your shareholders, then you tend to pay continuous dividends to make them happy. And also another factor, we need to talk about the competitors' dividend policies and the country's tax policy related for your dividends, like withholding taxes, and then the attitude of the management, what kind of attitude towards the dividends they have, and the positive NP projects and the performance of the organization. And like that, there are so many factors that you need to consider before you take your final decision. We discussed there are dividend policies like fixed dividend policy, dividend growth policies, and no dividend policies, such as in the real world. So having said that, we said there are some key theories related to dividend. First one, we talk about the dividends irrelevance theory. In the dividends irrelevance theory, it says the dividend, it is believed that dividends are irrelevant. Whether you pay or not, there won't be a change in the effect to the shareholders. In other words, if the company is paying dividend, the shareholders will be benefited from your dividends. However, if they did not pay dividends, you can reinvest that money for positive NP projects, and that will increase the value of the firm, which will lead to value of your share price, and that will reflect on a capital gain. So the wealth will be maximized either through capital gain or dividend. So therefore, either way, the shareholders will be benefited. However, this is challenged by the dividends relevance theory. What they believe is, because the future is uncertain and risky, it is better to get the dividend, whatever the dividend that you have today, rather than looking for a long-term return. But it has its own arguments on that. And also another theory that we can't forget is the signaling theory. Signaling theory refers that the firm signaled or firm will be, the image of the firm will be looked at based on their dividend policy. If a firm is paying dividends, it gives you a signal to the market that the company is performing. If the firm is not paying dividends, it gives a signal that the company is not performing in the business. So the whether to perform or not will be reflected based on the dividends payments. So they say dividend may act as a signal. If the firm is performing, such companies are paying high dividends. If the company is not performing, companies are not paying high dividends. So therefore, so signaling effect says, in order to give a positive image on your investors, the firm need to continue to pay the dividends. Right. So with that, I would like to conclude the dividend decisions of a firm. So these are the main decisions that we need to understand in order to maximize the shareholders' wealth.